Hi friends. So in the last session I have given the meaning of leverage, how it can be divided and what are the different classification of leverages. In that financial leverage is there, operating leverage is there and combined leverage is there. Now in this session we are going to the practical side of the computation of leverages, how we can compute financial leverage, how we can compute operational leverage and how we can compute combined leverage. First we can go to financial leverage, how we can compute financial leverage. So before starting with, I will just explain what is the meaning of financial leverage. Usually companies design their capital structure giving more prominence to debt capital, which will increase the return to equity shareholders. A company generating reasonably high returns will be able to pay dividend on equity shares relatively high. So, use of fixed charges sources of funds along with the equity capital to magnify the return of equity shareholders is called financial leverage or trading on equity. Last session I explained it. So, this trading on equity can be divided into what? Trading on thin equity and trading on thick equity. When the capitalization of the company is dominated by borrowed capital, it is trading on thin equity. When along with equity we are adding capital reserves and surplus, it is known as trading on thick equity. Now we can see how to calculate or how to compute the financial leverage. So, financial leverage or trading on equity is beneficial as long as the business is having or business is making profit above the interest payable on debt capital. If it is a loss, the financial leverage will lead to magnifying losses also. So now we can see how to compute the financial leverage. You can see the videos there. That is, financial leverage is calculated as EBIT divided by EBT. So what is meant by EBIT? EBIT means the operating profit, that is earning before interest and taxes. Before giving interest and taxes, what is the amount of profit realized by a company? That is EBIT. So, what is meant by EBT? From EBIT, if we are deducting interest, we will get EBT. EBIT, we are deducting interest, we will get EBT. So, here we are finding out the relationship between EBIT, that is earning before interest and taxes, and earning before taxes, not interest. Okay, so if this relation, it is coming to one or more than one, we can say the company is having financial leverage. If the measurement is coming one or more than one, we can say the company is having financial leverage. Now we can look into the videos with problems and solutions. Take the first problem. X Limited issued 10,000 equity shares of rupees 100 each, 5,009% debentures of rupees 100 each. The operating profit of the company during the year is 3 lakh. Compute the financial leverage and give your comments. Financial leverage, what is the equation? EBIT divided by EBT. EBIT, it is given 3 lakh. Clearly it is given. The operating profit of the company is 3 lakh, it is given. So EBIT is 3 lakh. What is EBT? From EBIT we are deducting the interest, then we will get EBT. We can see how much is the interest amount. See there, 10,000 equity shares of rupees 100 each and 5,009% debentures of rupees 100 each. 9% is the debt capital. So 5 lakh is the total capital. 5,000 into 100. 5 lakh is your total capital. On that 5 lakh, 9% means 45,000. So EBIT is 3 lakh. From 3 lakh we are deducting 45,000. We are getting 2 lakh 55,000. So 3 lakh divided by 2 lakh 55,000, we are getting the answer 1.17. The result 1.17 means, what is it? The company has financial leverage. The figure 1.17 means that the company has financial leverage. Understood? It's very easy. And we can see the second problem, the second one. Take the video. You are having the PowerPoint with you. A Limited proposes to start a new project at a cost of 10 lakh rupees. The company has two financing schemes under consideration. First is issue of 60,000 equity shares of rupees 10 each and 12% loan of 4 lakh. Scheme 2, issue of 30,000 equity shares of rupees 10 each along with 10% of debentures of rupees 7 lakh. The company has already issued 1 lakh equity shares of rupees 10 each. Compare the schemes and suggest which one is better to magnify the EPS. If the expected profit for the year is rupees 5 lakh, what will be your answer if the company makes a loss of 2 lakh rupees? Okay, that is the second one. Assume corporate tax rate of 35%. So we can make a statement that is, we are getting compare the schemes and suggest which one is better to magnify the EPS. If the expected profit of the year would be 5 lakh, that is our EBIT, 5 lakh. So we can do it as columnar. One is scheme 1 and the other one is scheme 2. In both cases, the EBIT is the same. That is 5 lakh each. Then from that we have to deduct the interest on debentures or interest on loan. In the first scheme, issue of 60,000 equity shares of rupees 10 each and 12% loan of 4 lakh. So on 4 lakh, 12% is the interest. So what will be your interest? 48,000 for the first scheme. And for the second scheme, 10% debentures of 7 lakh, that will be 70,000. That is for the second one. So 48,000 is deducted, and at the same time, which one is deducted? 70,000. So from EBIT, we have deducted what? EBT. We have deducted. So the interest we have deducted, so we got EBT. From that, here it is given corporate tax rate is 35%. So we have to deduct the tax also. So 35% tax also we have deducted. 4,52,000 into 35% and 4,30,000 into 35%. So it is coming 2,93,800. First one, and the second case it is 2,79,500. That is EAT, earning after interest and tax. Okay, this earning after interest and tax is calculated to find out the EPS. In the problem it is given, compare the scheme and suggest which one is better to magnify the EPS. So we have to find out which company is giving more earning per share. So we have found out EAT. Understood? So this EAT will be divided by the number of equity shares. Here it is given EPS equal to EAT divided by number of shares. In the first scheme we can see 60,000 equity shares of rupees 10 each. So how much is the amount of equity shares? 6 lakh. In the second case 30,000 equity shares of rupees 10 each, that is 3 lakh. So both EAT is divided by concerned amounts of number of equity shares. First case it is divided by 60,000. And the second case it is divided by 30,000. We are getting 1.83 and 2.15. So both the schemes are having financial leverage. Because both the scheme we are getting more than one financial leverage. But we can say which one is better, which one is getting higher EPS. The second is better as it gives EPS of 2.15. Earning per share, the second scheme is giving more. So we can say the second one is better. So that part is over. Now the second question is, the company is having a loss of 2 lakh. Instead of profit, we are having a loss. So again scheme 1 and scheme 2. The EBIT is loss, that is minus 2 lakh, minus 2 lakh. We have to deduct the interest, again minus. So the first case it is becoming minus 2,48,000 and the second case it is becoming minus 2,70,000. Whether tax is payable, it's a loss, so no tax is payable, so minus. So we are having minus 2,48,000 and minus 2,70,000 as EAT. Here EBT and EAT are the same as tax is not payable. Again, the concerned amount is divided by the number of equity shareholders. First case divided by 60,000 and second case divided by 30,000. We will get how much? Minus 1.55 and minus 2.07. So the earning per share is minus 1. The first case minus 1.55, second case minus 2.07. The loss is less in this case of scheme 1. If there is loss, the EPS is somewhat good in the case. So scheme 1 is better as it reduces the loss per share. The loss is less. So we can adopt the scheme 1 if there is a loss. So that question is also over. And the next one is DC Limited has 50,000 equity shares of rupees 100 each. The company is planning to expand and which it requires additional capital of 50 lakh and it has the following option. They are going to raise additional 50,000 capital, and which one is the better, that we have to find out. So we have to make columnar transactions. So we are making plan 1, plan 2, plan 3, plan 4. This we can find out from same pattern we are following. So you can take the examples and we can do. That is from EBIT, interest is deducted. Then we get EBT, from the taxes deducted, you get EAT. Then we are finding out the number of equity shares. The EAT divided by the number of equity shares, we got EPS. And at the same time, we also found out the financial leverage. So we have to find out which company is having the highest amount. So along with this, it is coming the degree of financial leverage also. The degree of financial leverage is the relationship between percentage change in EPS, earning per share, with the percentage change in EBIT. That is, whatever change in EBIT is there, accordingly, how much will be the change in EPS? Percentage change in EPS divided by percentage change in EBIT, that is known as degree of financial leverage. So this degree of financial leverage is also computed in some cases. So for example, and another example is also given taking into account the degree of financial leverage. In that case, operating profit is taken from the interest on debentures. Both cases it is deducted. We will get earning before tax. From that tax is deducted, we will get EAT. Then earning per share we got by divided by number of equity shares, and degree of financial leverage is calculated also. So this is what is meant by financial leverages. Financial leverage. So that part is over. Financial leverage is over. Now we will go to the computation of operational leverage in the next session. Hi everyone. In the last session we have already, in the first session starting with the leverages, we have already explained what is meant by operating leverage. And also I will just give a definition of operating leverage. That is the use of fixed operating cost to magnify the change in profits related to a change in sales. That is known as operating leverage. If the operational cost of fixed nature are more than variable cost, the firm has operating leverage. Once again, I will tell you, if the operational cost of fixed charges are more than variable cost, a firm has operating leverage. This is the definition given to the operating leverage. Now we can see how we can how we can calculate the operation leverage. The equation for finding out operation leverage is C divided by EBIT. So what is meant by the C? C is the contribution and EBIT means earning before interest and tax. Contribution is a term coming under marginal costing. Contribution studies, we are taking into account only variable cost, not fixed cost. So we can see how the contribution is found out. From the sales, if variable costs are deducted, we will get what? Contribution. So we can say sales minus variable cost, we will get what? Contribution. From this contribution, if fixed expenses are deducted, we will get operating profit. From this contribution, if fixed expenses are deducted, what we will get? We will get profit. That is operating profit or EBIT. So once again I will tell you, we are taking sales. From sales we are deducting which one? Variable expenses. We will get operating profit, we will get contribution. From this contribution, if we are deducting fixed expenses, we will get what? We will get operating profit or EBIT. So here we are finding out the relationship between contribution and EBIT. If we are finding out contribution, we can find out the break-even point also. Break-even point means fixed cost divided by PV ratio. PV ratio means what? Contribution divided by sales into 100. So we can find out this operating leverage by taking into account two elements, that is contribution and EBIT. Contribution is sales minus variable cost, and from contribution, if I are deducting fixed expenses, we will get what? We will get operating profit. So contribution can also be found out like this, that is fixed cost plus profit. That can also be so in the last session we have seen the computation of operating leverage. Now we are going to the computation of combined leverage. So we have already seen combined leverage is a combination of financial leverage and operating leverage. So it can also be defined as a percentage change in EPS with relation to percentage change in sales. How much will be the percentage change in EPS with a change in the sales? How much sales, if there is a change in sales, what will be the effect on EPS, earning per share? So we already said it is a combination. So what is the equation for finding out financial leverage? We have seen EBIT divided by EBT. So for finding out operating leverage, what is the equation? C divided by EBIT. So EBIT divided by EBT into contribution divided by EBIT. If both the EBITs have gone, so what is left out? Contribution divided by EBT. C divided by EBT can be the summarized equation for what? Finding out this combined leverage. Or we can find out financial leverage and operating leverage separately and we can multiply it. Then also we will get what? Combined leverage. Otherwise, C divided by EBT will be the combined leverage. So operating leverage magnifies the changes in EBIT level on account of changes in sales level. EBIT on account of changes in sales level. And financial leverage magnifies the change in EPS on account of change in operating profit. And the combined leverage signifies the change in EPS, percentage change in EPS according to a change in sales level. Understood. So now we can go to the problems in this combined leverages also. Take the first one. Take the first one in your video. That is B Limited has an annual sales of 25 lakh rupees, variable cost 15 lakh, fixed cost of 5 lakh. It has issued 12% debentures of 20 lakh. Calculate composite leverage. So, composite leverage we have seen, we can do in two terms. Either we can do C divided by EBT, or we can find out the financial leverage and find out the operating leverage and multiply it. So, C, operating leverage, contribution divided by EBIT. Here sales are given and variable costs are given, so we can find out the contribution. Earning before interest and taxes, 10 lakh is your EBIT. That is your contribution. From that we are deducting the interest. interest is 5 lakh. The fixed cost of 5 lakh. Understood? That is interest. It is not given interest, it is given as fixed cost. That is the interest payable on debt. So 5 lakh is deducted. So we got earning before interest and tax, that is 5 lakh. So operating leverage is 10 lakh divided by 5 lakh, it is coming to 2. Is coming to 2. Then financial leverage is EBIT divided by EBT. EBIT 5 lakh, EBT 5 lakh minus interest on debentures. How much is the interest on debentures? 12% on 20 lakh. So 2 lakh 40,000. So it is coming 2 lakh 60,000. So financial leverage is 5 lakh divided by 2 lakh 60,000. EBIT divided by EBT, it is coming 1.92. So composite leverage is the multiplication of 2. That is 2 into 1.92. It is coming 3.82. Take the second problem also. X Limited gives the following detail. Compute the operating, financial and combined leverage. Sales are given, variable costs are given, fixed costs are given, debt is given and equity capital is given. It is done columnar, that is computation of leverage. Sales taken, variable cost is deducted, we got contribution. From that fixed cost is deducted, we got EBIT. From that interest is deducted, we got EBT. Operating leverage is contribution divided by EBT. That is 15 lakh divided by 9 lakh, 1.67. Financial leverage is EBIT divided by EBT. That is 9 lakh divided by 6 lakh. It is coming 2.51. It is coming 1.50. So multiplication of both two. That is 1.67 into 5. It is coming 2.51. Other problems are given. Same type problems are coming. So we have completed the computation of combined leverages also, and with this the leverage part is over. Total leverage. So the leverages can be financial leverage, operational leverage and combined leverage. Hope you have understood and do the problems within the videos according to the explanation and the answers given. Okay, thank you very much.